Good evening, everybody. Thank you for joining us on this month's edition of the Monthly Market Insight. And of course, this month we are doing things in a slightly different way. We will have on this call two of our fund managers along with me. So, Ajay Tyagi, who manages UTI FlexiCap Fund and some of our other strategies, will also be on this session talking about his strategy and his funds. And also on this call will be Ankit Agarwal, who manages our mid and small cap strategies, and he'll be talking about his strategies and the positioning as well. Um, I'm delighted to see the large number of registrations we have today, and also very happy to see that many of you have taken the time and effort to send us your questions in advance, which is great because then we can make sure that the session becomes useful for all of you and we can address some of the questions which are relevant. Of course, it's always the case that we can't take all the questions, but we do make an attempt to collate them and then make sure that a response to those questions as well does get sent out to you later, even if it can't be addressed during the particular session itself. We're doing today's session in a much better frame of mind, and thankfully, the country's health is also vastly improved. I remember when we did this call in early May, that was a time of great concern for each and every one of us because of the health issues that people across the country were facing. The health system was, operating under great amount of stress, and individually, each and every one of us and our families, our connections are near and dear. There was, pain and suffering everywhere. But thankfully, today, I think the situation has improved dramatically. When I think about the city of Bombay, where I am, from the peak level of daily case loads, it's come down by almost 80 to 90%. And thankfully, the news on the vaccination front as well has improved quite dramatically, with a lot more people now being able to access vaccinations. And I think this week's announcement by the government, whereby it's now taking charge of procuring the vaccines for 75% of the total capacity, to be centrally led by central government procurement, I should say. I think that's a welcome step. And in fact, yesterday we also saw the finance ministry talk about, a target of getting 70% of the eligible population vaccinated by Diwali this year, which should bode well, not just for our health, but also for the economic health of the country and the ability for business and commerce to re-engage fully rather than be in a lockdown mode. So yeah, much better times as we speak today here in this first few days of June. As we do this session, I'll now get the presentation pulled up on the screen and very quickly run you through some of the macro factors before I hand over to Ajay Tyagi for his session. So without any further ado, let's dive straight in we can move to the next slide. My colleague Niranjan has graciously agreed to help out with the slides, and so he's in full control of that. Obviously, the second COVID wave is the matter of most discussion. As you can see over there, I think in early Jan, Feb, there was a sense that we had put it behind us, but there was always a risk of a renewed trend, as we had seen in many geographies across the world. And then we saw the second wave spike up very sharply. And as I said, in early May, that was a really difficult point in time. But clearly now the data from across the country suggests that the wave has clearly turned down, and that is great news. Very quickly, on the right-hand side of the chart, you can see the Google mobility trends. And as that suggests, we had lockdowns in many different states, different kinds of lockdowns. And it's a good thing that we didn't have a centrally mandated lockdown. It was left to states to determine how to proceed with the lockdown. And I think Maharashtra is a good example of how they've now put in place a framework such that each district can be distinguished from the other district in terms of its criterion. And only based on that are certain different levels of opening up being implemented. So once again, the mobility trend suggesting that the traffic is gradually coming back on the roads and people are able to re-engage with work and commerce and also their own personal life and connectivity. Moving on to the next slide. Right. So, what has the second wave really meant in terms of economic activity? So, let's just compare the setback in economic activity in wave two. These are on a very limited set of parameters. How much has been the setback to economic activity compared to 2020? And what you see here are two sets of bars. First is the blue bar. The blue bar refers to the year on year trend in activity. Uh, this compares the first wave to the pre pandemic period. The green bar is the 2 year trend, which is how does economic activity of 2021 compare to the economic activity of 2019. So this shows you the impact of the first wave, the blue bars, and the green bars show you the impact of the second wave. Some of this data, I would say, is not yet complete because some of the data points for May are not out fully. But as you can see, as compared to the severity of the lockdowns that we saw during wave one, you look at the numbers for car volumes and two-wheeler volumes down 90%. The second wave has been far more muted in that sense. Also, if we look at the e-way bills, because remember, every time goods in India now have to move under the GST regime, you have to generate a e-way bill. And of course, last year in April, May, the shutdown was national. So there was a 68% drop in the generation of e-way bills. But if you take the period of April, May, and this is up to early May, then the drop in generation of e-way bills is only a 4% CAGR over that 2 year period. So the impact on economic activity in the second wave has been far more muted. You look at electricity generation, once again, you can see the pattern. During the first wave, almost a 20% decline in electricity generation. But as far as the second wave is concerned, it is very, very muted. Similarly, if you go to the extreme right side bars, this is again quite interesting, which is to say that during the first wave, because of the national lockdown, everything had to shut down. And remember, even consumers couldn't come out to buy really in that sense, and therefore, and this was a global phenomenon. And because of that, exports saw a 44% decline in terms of activity during the first wave. But during the second wave, remember, large parts of the world stayed open for business, right? Because over the last 2 months, economic activity in areas like the US and Europe in particular have actually accelerated even when we were experiencing our second wave in India. And as a result, exports actually fared much better during this period. In fact, they were positive during this period. So this gives you a sense that the collapse in economic activity during wave two nowhere near as significant as it was during wave one. Moving on to the next slide. How have earnings behaved during this second wave? Now, all of you would be aware that when the first wave hit, there were dramatic reduction in earnings estimates. If you look at the chart on the left-hand side, you see the blue line. And then as we enter the period of the lockdown in the middle of March, you start to see the earnings estimates get cut very, very dramatically. And they go down by almost about 25 to 30% from a base level of 100 to about 75 by the time you reach the middle of May. However, this time around, if you see during the second wave, you see that green line, you can see that in fact it has stayed resilient through the period of April and May. Now, how has this happened? Why has this happened? Why have the earnings been so resilient? And remember, in both cases, we are talking about the 1 year forward earnings numbers. The reason for why these numbers have been rather resilient over the last 2 months is not because economic activity has necessarily been completely untouched. Remember, we already saw on the last slide, yes, impact is not as dramatic as wave one, but certainly there is some reduction in activity. The reason for why earnings have not been cut very dramatically is on the right side. When you look at that right side chart, this shows you the different sort of key factors which drive the Nifty earnings. So the biggest the biggest slice of that chart is banking and financial services, BFSI. That makes up 36% of the Nifty 50 earnings. And of course, that's completely domestic in nature. Similarly, domestic investment companies related to the investment cycle are 10%. Domestic consumption, right? Staples, discretionary, automobiles, garments, groceries, that's about 11% of the Nifty earnings. But the remaining two parts of that entire pie chart, exports make up 18%. Remember, I already showed you on the previous slide that export activity has remained untouched during this particular period of the second wave. And commodities, commodity prices have gone up very, very sharply compared to last year. So the strength in the export segment and the strength in commodity prices has really resulted in a situation where, despite some setbacks to economic activity, when you look at the aggregate Nifty earnings, there has not really been a setback. Suffice to say, given the lower levels of activity, I do think that there will be some earnings cuts when you look at the BFSI area, you look at domestic investments, you look at domestic consumption. One should expect that there will be some set of setbacks because for many companies, this quarter is going to be a very weak quarter. But the reason why the earnings have not declined is because of the strength in those two other segments of the market. And remember, put together, that's 43% of the Nifty 50 earnings. So this is really a key reason why earnings numbers have tended to be resilient in the face of the second wave. Moving on to the next slide. I won't spend much time on this. You all are familiar with this slide. We've used it every time. The final earnings numbers for March 21 are not yet out. I think one or two laggards yet to report. I think one company reported yesterday, maybe just one remaining now. So the earnings estimate for 21 is that earnings for the Nifty 50 will be up by 9%. Remember, I talked about this earlier. GDP is going to be down for March 21, but earnings for the Nifty 50 actually in positive territory. Similarly, for March 22, the earnings estimate remains a fairly aggressive 39% year-on-year growth, not much change from what we saw last month. Moving on to the final sort of summary slide that I'll leave you with. What has continued to give support to global markets has been the fiscal and monetary support across the world by governments and monetary policy bodies. And of course, the rollout of the vaccine. We discussed this last time. The US is targeting 70% of its, or in fact, 100% of its adult population being fully vaccinated by their Independence Day, which is July 4th. And that is great news. What is also good news is that, remember, US is the house of a lot of the capacity for vaccine manufacturing. And there are initial signs that the US is now willing to direct some of that capacity to other parts of the world. And I think that's good for the rest of the globe as well in terms of the recovery. Inflation numbers just out yesterday in the US, very high compared to what one has been used to. But clearly, policymakers' view right now is that this is transient. This is a function of supply disruptions, and therefore they are tending to look through it, which is why you saw even yesterday when the high inflation number was reported, the US 10-year bond did not really react. In India, the outlook is underpinned by reforms and a supportive fiscal policy, equally by the RBI and MPC maintaining a accommodative stance. We already talked about this earlier. The outlook for exports remains bright. And even though the Indian economy may currently be lagging the recovery that's taking place in other parts of the world, it means that exports are likely to be a key contributor to the growth in this quarter and perhaps the next quarter as well. And that gives the domestic economy some time to kick in. We've already talked about the fact that companies that can navigate a difficult period very often accelerate both growth and profitability due to reduced competition. And the earnings numbers I talked about on previous slides reflect that. Yes, valuations are slightly rich when you compare them to past history. That makes the markets vulnerable to any setback. But I also spoke at length about this last month to say that when you compare the earnings yield to the bond yield, which is a way of comparing equities to the alternate asset class, which is fixed income, then the valuation argument is more neutral. It's not unambiguously in favor of debt vis-a-vis equity. So neutral from the position of one asset class vis-a-vis the other, but certainly elevated from the point of view of valuations related to history. So that's sort of a summary of where we stand at this point of time. Some optimism given the rollout of the vaccine. And if, as the finance ministry spoke about yesterday, we can get 70% vaccinated by Diwali, I think that would be great news for all of us individually and certainly for the recovery story of the economy as well. I'll come back later and we'll take some of your Q&A. But what I'm going to do at this point is now hand over to my colleague, Ajay Tyagi, and he's going to talk about the UTI FlexiCap Fund and the investment strategy. Over to you, Ajay.
Yeah, thanks, Vetri, and good afternoon, everyone. Thanks for joining us. So I'll quickly jump into the core investment philosophy of the FlexiCap Fund. Right in front of your screen over here. Many of you would have heard us discuss this philosophy, but what would be, I think, interesting for others who are listening to us for the first time to just refresh this. UTI FlexiCap Fund stands for high quality businesses. And of course, quality is a term which everybody can use loosely, and everybody can talk about their underlying portfolio being a high quality portfolio, but ultimately it should show up in numbers. And therefore, we define quality more objectively as businesses that can generate high return on capital employed and businesses that basically can generate strong cash flows. In fact, fundamentally speaking, high return on capital and high cash flow generation are joined at the hip. You would typically see businesses with high profitability as measured by their high return on capital, who also throw out strong cash. And it's important to keep reminding ourselves that businesses that generate strong cash flows are the ones that are creating economic value. And for creating sustainable wealth in the long run, it is important to invest into businesses that are creating economic value. So this, you can say this very, very strong focus on cash flows is because of fundamental reasons. Strong cash flows lead to strong value creation in the business. The intrinsic value of the business continues to grow. And if the intrinsic value of the business is growing, then of course you would see their market value also growing. And that's the effort that we have, which is to invest into businesses that continue showing growth in their value, and therefore in the process create wealth for us. And if you look around cases in the last 10, 15, 20 years, those typical names that come to our mind which have created very strong wealth and in a highly non-volatile manner, at least in a relative term we can say that, and have been fairly predictable businesses typically have been high quality businesses. So that's our reason to remain focused on quality. Quickly moving on to growth, very important because we are fairly patient investors. Once we identify businesses, we want to remain in their midst for a fairly long period of time. We're not investors who would jump in and jump out looking at either some short-term valuation mismatch or looking at trends which can favor certain industry over the other. We look at the outcomes of the business from a 3 to 5 year perspective, whether these outcomes make us convinced about value creation happening in the business or not, and therefore we remain patient. It is because of this reason that it is important for us to look at growth happening in the business that we have invested in. Because if growth stagnates, value creation will also stagnate. And if growth continues to happen, value will continue getting compounded, because of which we will also see compounding of our wealth. So we are within the set of high quality businesses. We are looking at businesses which are also having strong growth drivers well into the future. Valuation, I think we'll come to this in a bit, but I should emphasize here that this strategy is not mindless about valuation. This strategy is not growth at any price or quality at any price. We are very, very patient in terms of building exposures. When we identify great businesses, and within those great businesses, when we identify businesses that can show strong growth, we remain fairly patient in terms of building positions into them. Because like I said a while back, we are not buying them for a very quick 30-40% return just because of a valuation mismatch. We are buying them so that we can ride on their entire value creation journey over the next 3, 5, 7 years. And if that's the case, it doesn't matter whether we lose the first 20, 30, 50% and so on. So therefore, we remain gradual in terms of building exposure, capturing various points of time in terms of valuations of these businesses over a few quarters, taking advantage of volatility, taking advantage of a few slips here and there by companies when they report their quarterly earnings. So that's the broad framework for valuation, but I'll come to this in a bit. Niranjan, we can go to the next slide, please. This is the sectoral breakup for us. Right at the top, you can see financial services, which occupy almost 1/4 of our portfolio. IT services at about 14%, consumer goods, and this consumption theme is actually spread across many different sectors in our portfolio. The consumer goods that you see here are basically the consumer staples companies and also some consumer durables companies. Pharmaceutical, a big exposure, almost 11%, and I look at the overall healthcare opportunity in India as a very, very strong, sticky opportunity for many decades. And that is why when we look at the overall healthcare set for us, it should be pharmaceuticals plus healthcare services, which is another 5%. So healthcare overall, which includes healthcare services and pharmaceutical companies, is a 16% exposure for us. And we are very bullish on this theme because as per capita income would continue to grow, as humans, we would all want to take care of our well-being, our families' well-being, our healthcare. We all want to live long, live healthy, and so on. And therefore, this trend will remain a very strong trend so far as the Indian economy is concerned. Likewise, automobile, an important sector. We are all aspirational. We all want to buy good cars, bigger cars. This is also a direct correlation to the ever-increasing per capita and therefore disposable income in the country. And then there are smaller exposures on the chemical side, smaller exposures on fertilizers and pesticides. But if you look at the broad overarching theme of our portfolio, quasi-consumption or direct consumption related sectors are the ones which are occupying 85% of our portfolio, number one. Number two, we want predictability of businesses. And therefore, a lot of these businesses which are highly unpredictable, volatile, or cyclical, you wouldn't see them in our portfolio. They could be metals, they could be oil and gas, they could be businesses from, let's say, the infrastructure or aviation sector. Wherever we see a huge amount of cyclicality, we find it difficult to build a framework of quality around them, and therefore, you would typically see us not having any exposure from these sectors. Yeah, next, please.
Thanks, Ajay. Before we jam in Ankit, so we had received a few questions from our participants. What we have done is we have posted them on the screen. So I'll just read out for you. So mid and small cap have actually done extremely well compared to the large caps over the last 1 year period. So what is your current stance on mid and small cap allocation in the FlexiCap fund?
Sure. I think this is a very important question. So you see, we are bottom up in our approach towards portfolio construction. In fact, I would say even stock selection is absolutely bottom up. So for us, it's important to test every business from a quality growth perspective. We are not bothered as much about whether this would lead to our mid-cap allocation going up or our large cap allocation going up. We are not conscious about the fact, first of all, it's a flexi cap category. Therefore, as we all know, we can have any mix of large, mid, and small. There are no regulations around how much of large, mid, or small should be. So therefore, the turf is open for us. The way we've been approaching this product or this fund is that, look, the best ideas from the quality plus growth. And I'm repeating, our portfolio is working at the intersection of both quality and growth. We want both attributes. So ideas which actually fit into this framework would come in. We are not bothered about whether the ideas would come from large, mid, and small, and we just keep it open. And therefore, if you ask me this question today, Our stance, I would say, look, if there is, despite the fact that mid and small caps have done so well in the last 1 year and their valuations have also increased, if I find a very attractive idea from the mid and small cap segment, I would not shy away from it. It's the business and the outcome of the business that is more important for us to understand, and therefore build exposure around such businesses rather than anything else. So we are bottom up from a large, mid, small perspective. We are bottom up also from the perspective of whether we are overweighting or underweighting a sector, which we don't do. The numbers that I showed to you are just an outcome of our stock selection and nothing else. Yeah.
Thanks, Ajay. The second, there is another question. Yeah. So PE ratio of UTF FlexiCap fund seems to be high. Can investor hope to make strong long-term returns even from such PE levels?
Yeah, I think this is again a very important question from the perspective of the FlexiCap fund, because many investors always look at the portfolio and say that, look, we know it's high quality, but then isn't it too expensive? And if you are buying it too expensive, would we be able to make money in the future? See, there are a couple of things that I need to bring out in front of you. Point number one, and of course, we don't have time to discuss this in detail, but you see, the price earnings multiple of any business is determined by three things: its return on equity, its growth, and the third variable is the required rate of return. We also call it the discount rate. Assume that for a country like India, the discount rate is the same for all the businesses. We make that simplistic assumption, but it's not too aggressive an assumption to make. So let's knock that variable out. Whether we value Nestle or we value Tata Steel, let's assume that the required rate of return is the same, which basically means that price earnings multiple is now a function of only two things: return on equity and growth. If return on equity is high, price earnings will be high. It is just a mathematical formula rather than anything subjective. If growth of a business is high, it will again command a very high PE. And if both things are high, you can imagine it will command an even higher PE. The key to understand here is, will return on equity remain strong for the next 5, 10, 15 years or not? Will growth remain higher than India's nominal GDP growth for the next 5, 10, 15 years or not? And by first of all, by checking our businesses for quality and looking at their historical track records, and also trying to understand the reasons why quality will persist into the future, we try to remain convinced on ROEs remaining strong for the next 5, 10 years. Likewise, we look for drivers for growth. Avenue Supermarts or DMart as a company, very, very high PE, because it has a reasonably strong ROE, but a very strong growth outlook. Why would this growth remain strong for the next 20 years is something which is the most important thing to understand. If we have convinced ourselves on growth remaining strong, believe me, even if you buy that business at a very high PE, you will still make money, provided your time frame is at least 3 to 5 years. If your time frame is 1 year, anything can happen. And I think that's why, while Kotak and HDFC Bank have always been trading at 3.5 to 4 times price to book, you pick any time period over the last 5, 10, 20 years on one side, and SBI has always been trading around 1 time price to book. Again, any of the times you take in the last 20 years, you still know that despite high price to book value, Kotak and HDFC Bank have delivered much better and much more higher predictable returns because of their high ROEs and high growth. So that's the answer to this one, Niranjan.
Sure. Before we move to Ankit, one last question. Yeah. As assets of UTF FlexiCap fund has crossed the mark of rupees 18,000 crores, so can the fund size be a deterrent to your investment philosophy?
Well, okay. I'll answer it in 2 different ways. Number one, please do also consider that the market cap of India is also increasing. It is $3 trillion today. And it was, let's say, $2 trillion or $1 trillion more than a decade back. So, when we look at the size of our funds, we also have to look at that, is the economy showing growth, and therefore is the stock market showing growth? If the market continues to show growth, and if our assets are also increasing in proportion of that, there's nothing to worry. But sometimes our assets increase in a higher proportion to the increase in market cap. it becomes a challenge provided, and of course, it becomes a challenge more for people who have this strategy of, like I had explained briefly, people who spot an opportunity, get into it, and then try to get out after 1 year. In a philosophy, in a strategy like ours, which has a turnover ratio of between 10 to 15%, we are talking about holding on to our businesses for approximately 8 to 10 years. It is that long a horizon with which we have been managing this. Therefore, we don't have the requirement to come into a business, build exposure, and then after 1 or 2 years exit. As I mentioned, even in the small and mid caps where we are building exposure, we may take years to build a 1.5% exposure, because if it is really a decade-long opportunity, what's the hurry to buy everything within 1 quarter? So that's how we look at building exposure into our businesses. We are patient on the way up. We are also patient on the way down. And till now, I don't think size has been an anchor to us. We feel extremely comfortable in making a statement that even if this 18,000 crores were to become 30,000 crores, we will not be changing the way we have been managing our fund. After 30,000 crores, we will refresh and maybe we will look at this question again, but it's not something which worries us right now. Yeah.
Thanks, Ajay.
Niranjan, I think,
yeah, thanks, Ajay.
Yeah, I was just saying that maybe we should hand over to Ankit now.
Yeah. Good evening, everyone. This is Ankit here. I'm here to present on the UTI Midcap Fund and the strategy that we follow here. I think I've been looking at this midcap space right from the beginning of my career. And, one thing which I've learned over the years is that, the way you make money in the mid and small cap space is that you buy businesses which have a long runway of growth. And if these businesses are run by good quality seasoned managements who have strong execution track record, have high levels of integrity, and who are able to reinvest their capital into the business at high ROICs, then these companies would be able to sort of compound earnings over a period of time. And therefore, your investments in them will also compound over a period of time. So I think it is with that core philosophy that we run the UTI Midcap Fund strategy. So what we are looking for, and these form the core of the portfolio. So almost 70% of the portfolio would be in companies which are typically leaders in the space that they operate in. And that leadership could be exhibited either in the form of cost leadership. They might be innovative in terms of the products they come out with. They might have brand leadership. And then in terms of outcomes, it gets reflected in the form of high returns on invested capital. So these are, businesses which will basically be the core and compound your earnings over a period of time. And therefore, they will form the core of the portfolio. And we sort of complement this with, around 30 to 40% or around 30% of the portfolio in what we call turnaround strategies. Now, what is typically a turnaround strategy? We are still looking at sound businesses run by good managements. But it is possible that these businesses are going through a weak operating phase today. Maybe, the sector isn't doing well. It's going through a cyclical downturn. And therefore, it gives an opportunity to select companies over here who are able to survive this sort of a downturn, have good balance sheet, well-managed balance sheets. And if they survive this downturn, what will happen is, from a supply side, you will see a lot of companies exiting that sector. And when the revival happens, these companies will disproportionately benefit, not only from their top lines growing significantly, them able to capture larger market share, but also operating leverage playing out, which would basically mean that your bottom line growth will be much higher. And also, you get benefit of valuations mean reverting. So you get dual benefit of not only earnings growth, but also valuation uptake. And therefore, this strategy basically can help you make slightly higher returns over the period. The only catch over here is that you have fairly, the amount of opportunities available in that space might be limited. And therefore, you have to be very choosy as to what you are sort of selecting as a turnaround opportunity. And therefore, we restrict it to around 30% of the portfolio. Within that sort of a subset, we also look at what we call transformational opportunities. Now, transformational opportunities are typically companies, which might be going through a certain transformational change within the business. It could be that you have a change in management, and therefore, earlier maybe the management wasn't so focused on the business, and now with maybe a new management coming in, or maybe the next generation coming in, you see a renewed vigor in which the business is run, and that gets sort of reflected in the operating metrics significantly improving, and therefore a scope for re-rating. And that would be basically a structural re-rating that could play out with companies present in that space. So that is a much smaller subset within this whole turnaround play. And if you are able to catch some of these, again, you'll get benefit of a structural re-rating playing out, and also a long runway of growth. So therefore, we follow a fairly balanced approach to investing, where you have a core that should provide a lot more stability to the portfolio, and then that is sort of fairly well complemented by a slightly sort of a value-oriented approach where you can get the added alpha in the portfolio. Yeah, next slide. Yeah, so I mean, like what Ajay follows, we also have fairly bottom-up approach to investing when it comes to mid-cap companies, and I would say that the sectoral allocation is actually a summation of the bottom-up opportunities, rather than us having any significant positive or negative view on the sector. It could be so that you might be positive on a sector on a macro level, but maybe in the mid and small cap space, you may not have the right opportunities to play that, and therefore you might have a sectoral sort of underweight over there. But having said that, if you look at the portfolio composition today, you would find that there are a lot more opportunities we like in the consumer goods, consumer services space. Again, where we are playing a long runway of growth. A lot of these opportunities benefit from themes in premiumization, more higher penetration playing out, and as per capita incomes increase, you would see a significant benefit coming into these companies. They also, and that is a trend that we have seen in companies in the last 1 year, is that you have seen a significant market share shift coming in from the unorganized and weaker players to the larger organized players. And therefore, the leaders have actually been able to consolidate market share and in fact grow market share in the last 1 year, and which is a trend that we were already observing, but got expedited last year. So I think that is, again, a theme that we believe will continue to play out going ahead. I think second area where we do see a lot of opportunities is where the global supply chains are sort of reorganizing in view of the current geopolitical scenarios globally. And the benefit of that you could see in terms a lot more manufacturing coming to India. So it could be in the form of manufacturing of chemicals, which cater to the agrochemical space. It could be for pharma, APIs, contract research. You would also see a lot of manufacturing in auto ancillaries also coming down to India. And therefore, there is a possibility that companies present in that area would stand to benefit. Again, we also believe that there is a long-term opportunity in the healthcare services space. Again, there, what we have seen in the last 1 year is a clear example of the fact that Indian economy as a whole is fairly deficient as far as the healthcare infrastructure is concerned. And opportunities, therefore, in hospitals, diagnostics, our senses that will give us a fairly long runway of growth to ride on. So that is one, areas where we're quite positive on. Again, auto is one area where we sort of, which would play in that whole turnaround strategy theme, where we have seen last 2-3 years of sort of a muted growth for a variety of reasons. And our sense is that as economy picks up and demand picks up, companies will see a disproportionate benefit, not only from earnings going up, but also sort of valuation picking up in that space. Areas where we typically don't, pick up companies is one where we have sort of doubt about management's ability, integrity, or capability. I think those are the areas where we sort of remain quite underweight. And also in areas where terminal values seem to be at significant risk, where we believe maybe the businesses themselves might not exist sometime in future. I think those are the areas where we are quite wary of investing. Yeah. Next slide.
Thanks, Ankit, for that short and crisp rundown on the fund. So we have received few common questions on mid-cap. So we are posting that on the screen. So which sector will be back in focus amid the current lockdown scenario? So what is the strategy that you have adopted in the UTI mid-cap fund to pick such opportunities?
No, I think one point, which sort of I'm sure you would, in our interaction with a lot of the FMs, you would realize is that our strategy is aligned to longer term trends rather than playing any shorter term event driven opportunities. Therefore, if you look at the portfolio composition pre-COVID versus today, I think you'll not find a significant change in the portfolio composition from there to now. So, our focus has historically been to, like I said, in opportunities which are more long-term in nature. And what we have seen in the last 1 year is purely that some of these opportunities got expedited a lot, so whether it's in the form of formalization, digitization, higher financialization, I think those themes which were anyways sort of playing out, those got expedited. So I think, we do not focus on shorter term trends and try to play those. Our sense is that it's best to look at portfolio construction from a more longer term perspective. Only thing which I would add is that, like any strategy, the 30% of the turnaround play that we have in a portfolio, that, there could be a lot of opportunities today, which could have arisen in the travel, tourism, or allied spaces, which could benefit from, growth in that sector. And therefore, our sense is that, you're better off playing some of those maybe in this current environment. But beyond that, I don't think, we change our long-term strategy basis what we are seeing in the shorter term.
Yeah, moving on to the next question. Just a second. Yeah. So given the strong YTD performance by mid and small caps, how are you navigating the challenges posed by the valuations?
No, clearly, I think, I would agree that the valuations, at least in the near term, have become a bit punchy, and therefore, you cannot sort of, deny the fact. But I would say that, when you're looking at mid and small cap investing, you have to be slightly long term in your view. Therefore, like I said, the 70% of my portfolio, we are playing long term structural opportunities which will unfold over a period of time. It is possible that in the interim, you might see a slight pickup in valuations, and you are okay with that as long as your long-term structural opportunity still remains intact and the valuations are not accounting for future growth in the business. So I mean, I think we look at it. You have to look at it from a slightly longer-term perspective. I think where you do need to be a little bit more cautious is that 30% of the portfolio, which is more sort of turnaround play, and there we are a little bit more cautious when it comes to valuations, and we do regular profit booking over there because we do not want to be in a scenario where we get into the other stage of the cycle and we lose out the cyclical upturn that we saw in the opportunity.
Thanks, Ankit. One last question before we open it to the questions which have come online. So India is once again witnessing gaining momentum in IPO market. So would your UTI Mid-Cap Fund strategy is open to explore such emerging opportunities which have unicorn-like characteristics?
Yes, I mean, clearly, there are a lot of opportunities. We have seen a slew of IPOs coming in, and there is it seems to be a fairly large pipeline of IPOs in future. I would say that we are open to exploring a lot of these opportunities because they give you exposure in some of the new emerging sectors. But one has to be really cautious about what you're paying into some of these IPOs, and therefore you would find us a lot more selective and choosy with respect to what we invest in, and therefore while we have an internal sort of research team which analyzes these opportunities, we do not want to be in a scenario where we overpay for what these IPOs are offering. So I think we are open. Very short answer is we are open about these opportunities, but each one has to be, a lot of due diligence goes behind determining whether we are going to go ahead and invest in any one of them or not.
Thanks, Ankit. So now we will take the questions which have come online. I request Vetri Ajay to be back. So I'll take as many questions as possible in the next 20 minutes or so. First question that we have received here. We also got the questions from some of the MFDs through our email, Ask UTI. So I'm taking that first, and I will move to the chat box later on. So let the questions keep coming in for Vetri, Ajay, and Ankit. Vetri, the first question goes to you. So in your deliberation, you mentioned that India's exports may improve on account of capital inflows to emerging markets, and India remain among strongest. So on this note, are you expecting any sort of headwinds in the near term? And what factors or drivers do you think would continue to help India to get incremental foreign flows aiding to the exports?
Yeah, thanks, Niranjan. But actually, these are two separate things, right? One is the trades in goods and services, and that is what we are referring to when we talk about exports. The logic there is very simple. There is significant fiscal and monetary stimulus that has been provided in the developed world. A lot of that is likely to convert into demand for goods and services by consumers and businesses. And that is what will actually drive the export demand from India. The argument for flows of capital into India are slightly different. I would actually argue that in the longer term, the main reason to be fundamentally positive about flows into India has got to do with the attractive growth opportunities and the opportunity for large companies or funds to deploy capital at scale in India and participate in India's growth. Having said that, during a period when we see the dollar weak, there is always some amount of a carry trade happening between developed economies and the developing economies where the cost of capital is higher. And therefore, given that rates are likely to be weak and low in the US for the foreseeable future, based on their own guidance, you will see positive capital flows coming into India, but equally into other parts of the emerging world. This has typically been a historical trend, but I would really say interpret both of these separately. But yeah, I hope that explains it. Thank you.
Yeah, so there is one follow-up question which is coming on earnings. It is coming from the participants online, Mr. Shakir and Nishikant Hare. The earnings actually is muted after this second wave of COVID. So what is your expectation on the upcoming earnings maybe in the next couple of quarters?
So actually what I showed in my slides was the consensus estimates as per Bloomberg. And what those consensus estimates show is that even as of today, the consensus estimates about 38% EPS growth for the Nifty 50 in March 22. So it does appear at this point of time that there has not been much of a reduction in consensus estimates, despite the fact that this quarter is going to be a weak quarter, particularly for some of the domestically oriented consumption and investment businesses. I would still submit that given the weakness in this quarter, there is likely to be some setback to overall earnings expectations for March 22 when you see the Nifty 50 consensus. But because of the strength in global commodities and exports, it's offsetting the weakness. So to cut a long story short, it doesn't look like the earnings are seeing too much of a cut at an aggregate level. But cut at an aggregate level is very different from cut at a company-specific level. So there could be companies which end up with 5%, 10% cut in their earnings. Equally, there are some companies which are still seeing upgrades to their earnings. But when you put it all together, as of now, the consensus does not seem to be cutting earnings estimates. It's what the consensus is at this point of time. My gut feel, you could see a little bit of a setback, but it will not be too pronounced because as we saw some of the data, the economy seems to have picked up steam in recent days, and the setback was not as significant as the first wave.
Thanks, Vetri. So I'll take one question to Ankit. The highest overweight position for the fund, UK Mid-Cap Fund, is in consumer goods sector. So what is your strategy in picking stocks within this sector, which typically has higher valuation? And how is the discretionary part of the sector is expected to emerge from this current challenging phase? Maybe Vetri can also add a little later.
Yeah, I mean, I think the strategy is very clear. You are looking for companies which exhibit some amount of leadership quality in the segment that they are present in, and therefore, they are able to sort of generate high returns on invested capital and are able to sort of manage, this leadership over a period of time. So that's what you're primarily looking for. The reason for having a high weightage is, again, like I said, it's sort of a combination of bottom-up opportunities. But we do believe that there are, a lot of long-term opportunities available in the consumer space, and especially on the discretionary side, because, still the penetration levels in India are pretty low. And as we have seen in different categories, as the per capita incomes keeps going up, you do see these companies benefit disproportionately. Moreover, we are also seeing that the trends that we're seeing on more formalization, and a lot of these sectors, especially in the consumer durables, maybe on the brown goods side, do have a significantly large unorganized segment. I think what we have also seen in this last 1 year that the unorganized segment has become significantly weak. And within the organized space, also the smaller fringe players have again lost market share. So I think the trend has been that some of these companies will continue to gain market share, and that's what we are also sort of betting on. As we look at these companies riding on their long runway of growth. I think some of them are discretionary. Some of them have actually benefited from this market share gain, but some of them which are on the more retail, more travel linked, I think those have seen a significant drop in earnings. Our sense is that as the penetration of vaccination goes up, and as long as these companies are able to manage their balance sheets well, they'll emerge much stronger as the weaker players, they move out of the market.
Sure. Thanks, Ankit. I'll take one question to Ajay. So the question is coming from Mr. Subrata Chakraborty. So his question is, in the current period of pandemic, specialty chemicals and diagnostics within pharmaceuticals or healthcare sector have actually done exceptionally well. So, but these sector, the subsectors actually have very small component of the overall pharma sector. So what's your call there, Ajay?
No, so I think so let me take the diagnostic sector first. I think that's a sector which clearly is a sector which appears to be in its infancy right now and would have strong growth drivers well into the future. I mean, I don't know the vintage of the gentleman who was asked this question, but I remember when in the 80s, when I was a student, there weren't any diagnostic centers in Delhi. So the doctors would ask you to open your mouth, they would sense your pulse, they would look into your eye, do some diagnosis, and then prescribe you a medicine. All of that has stopped now, at least in the bigger cities, state capitals, tier 1, 2, or 2 cities. Whenever you go to the doctor wants you to do a set of tests, then come back, and then the actual prescription is done. So therefore, that's the way I see the entire medical fraternity moving forward. That's the way we see a lot of this these tests being done well into the future. But these are all tests post illness. They are called the illness tests. The other part of this industry which is now booming is what is known as the wellness part of tests, which is that all of us want to be sure that there's everything fine with us. So every once in a year, some people even twice a year, go for what are these wellness tests. And because these wellness tests are also supported by diagnostic chains, you end up going to either to the big hospitals or even to these diagnostic chains. So I think plenty of growth drivers. In the FlexiCap fund, we are very, very bullish about this sector, almost 4% weightage there. Specialty chemicals, I think that's a more tricky one because I say that because the chemicals industry per se over the last 2-3 years has gone into a bit of a boom. Just the other day, all of us in our team were joking that maybe 20 years back, every company wanted to suffix technology to their name. 10 years back, every company wanted to suffix infrastructure to their name, just like right now every company wants to suffix some form of specialty chemical to their name. So this is more tricky. Of course, there will be winners there. There are a few businesses in our portfolio as well, but I think the exercise here is a little more, I would say, arduous, and therefore we will take time before, from the perspective of the FlexiCap fund, before we are sure that the business does have quality and stickiness in growth well into the future. Yeah.
Thanks, Ajay. I'll take one more question for you. So, coming from our investor who has joined online, Mr. Lakshmanan from Tamil Nadu. So, since I've actually slightly modified his question. So, since UTI FlexiCap portfolio consists predominantly the sustainable businesses, so is this an ESG-friendly portfolio? If as what percentage of the portfolio would the fund have overlay of ESG principles?
See, ESG is an evolving subject, so whatever I say today may not hold water 1 or 2 years down the line. I may call my companies are highly sustainable, but once we start viewing them through a much finer lens, only time will tell whether they really were the ones which are high up on the ESG scale. But yes, there are a few reasons because of which naturally, not that we have spotted the right kind of companies which are also the most ESG compliant in India, but I think naturally, there are a few reasons for which we are compliant. I think I made a mention that we don't invest into capex heavy businesses. We don't invest into oil and gas. We don't invest into metals, because these are sectors where we have found that it's difficult to find businesses with strong ROCs. ROCs are highly cyclical. Through the cycle, ROCs are not strong. Growth itself is highly cyclical, and these are industries where where majority companies have kind of faced issues on the ESG front. Consumption, healthcare, IT, these are and banks. These are companies which have found it fairly easy to check the boxes on the ESG side. So I think it's because of that. But of course, yes, maybe Vetri can talk about this. UTI has embraced ESG framework, and I think all our funds would also be now looking at picking businesses with low ESG risks eventually, if not immediately.
Yeah, Vetri, would you like to add anything there?
I think Ajay has already covered that, and I think unfortunately the scoring approach leaves a lot to be desired, because the templates for scoring tend to be derived predominantly from, let's say, a developed world perspective, which may not be appropriate. But I think at UTI we have certainly commenced that journey in terms of more and more thinking about these ESG issues. We are signatories to UN Principles for Responsible Investing, which requires us to, every year go through a review process where we demonstrate that we are continuously enhancing and incorporating elements related to responsible investing into our process. So we have made those changes, and we will continue to, evolve around that front. I think even within the domain of ESG, there are many ways to invest. You could look at a exclusion-based approach where you say, I will not invest in these industries. You could practice a best-in-class approach, which is to say within every industry, I will look for who's best on parameters, or you could even look at an incremental improvement approach. To my mind, I think in India's context, the incremental approach is really the best way to go, rather than to start with a predefined sense of, exclusions. I think going the exclusionary route is perhaps appropriate in some developed countries, particularly Europe, but I'm not sure how appropriate it is in the Indian context. So incremental improvements by companies is what we are pushing for. We are engaging with companies, and a lot of our conversations with companies today revolve around these issues related to sustainability and responsible practices.
Thanks, Vetri. One question is coming from Mr. Nitish, MFD from Punjab. This is on the US bond tapering program. So his question is like this: is there any risk to emerging markets from US bond tapering program by Federal Reserve in near to medium term? So if you can share some light on that.
Sure. So we touched on this last time as well. See, when there is a crisis, there is an economic problem, it is the job of the central bank to come in and provide liquidity. But why do they provide that liquidity? They provide that liquidity so that the economy can get through the difficult path and return to the path of growth. When the economy returns to the path of growth and it is self-sustaining in its own ability, then there is no need for the central bank to continue to pour liquidity to support that economy. So I think the central bank will have to pull back from its policies of supporting the economy with so much liquidity at some point of time. That is a given. I think a lot of the discussion around tapering relates to the fact that there was a scare about this in 2013. But important to note that this time around, central bankers have become a lot more cautious because of that experience. So what they are trying to do is telegraph to the market well in advance that, as we see economic advancement, we will take the necessary steps to reduce the amount of fuel going into the engine. And that is only logical that they should do that. So I don't see tapering, as long as it is supported by a self-sustaining pickup in growth, to be a challenge. Unexpected developments related to tapering can surprise the market. Certainly, those cannot be ruled out. But I would say this time around, policymakers are being a lot more cautious.
Thanks, Vetri. So one question is coming from Mr. Sukumar Krishnamurthy. I'll request Ankit to answer this. In fact, the question is on mid-cap. So do you think the large percentage in the financial service in the current pandemic situation is risky?
Sorry, large percentage in? Can you please repeat the
financial
question?
Services?
Yeah, so as far as investments are concerned, I would say that, if I look at the mid and small cap space, you have to be a lot more bottom up when you're looking at the financial services sector. One could argue that the companies which will withstand the current pandemic much better would be much larger banks, with their ability, where they have sort of raised capital, or, they have sufficient buffers in place to withstand any impacts from, the second wave. And to that extent, when we are looking at some of the companies in the mid and small cap space, we are sort of quite choosy about what we are looking at. Especially, when you have to play the space from not just a post-pandemic perspective, but also from a longer-term perspective. So therefore, you would see that in our portfolio, we are significantly underweight the financial services. And that's purely a reflection of the fact that even in good times, I would believe that there is a case for only very select larger, financial institutions to do well. And the smaller ones sort of stagnating and not being able to, significantly grow their balance sheets in a significant way. So we are quite choosy. If you look at the mid-sized financial services space, it has a lot of, PSU banking, mid-sized PSU banks, a lot of wholesale focused NBFC. So one has to be really careful about, what is sort of their asset quality going to be, and their ability to A, raise capital, B, also to get liquidity from banks. So all those factors go in. And I would say that this is not just a pandemic phenomena, but I think even a post-pandemic, these will be important questions to answer before you can take any view on financial services, especially the lending financial services in the mid-sized space.
Thanks, Ankit. We have already crossed the scheduled time. So we will take last two questions before we wrap it for the day. Maybe this question can be taken by Vetri. This is coming from a few of the distributors. A couple of them actually had mailed us, and one is actually asking the same similar question online. So MFDs like Ari Kamath, Babu Arunachalam, Pramod Nayak. So in the recent times, there has been growing interest of investors towards the funds that are optimal in its risk and reward. So therefore, do you think products like Balanced Advantage or features like STP boosters or Flexi STPs, which actually take care of market volatility, are the solution to the investors? And also, what strategies would you advocate investors who are looking for better risk-adjusted investment over long term?
Very quick answer to this. I think a good advisor would be able to adjust the asset allocation of an investor in a way that it provides them with better risk-adjusted returns, which in a sense is what, let's say, a UTI multi-asset fund tries to do using a valuation model, or the category of balanced advantage funds is supposed to do by playing between the two asset categories. So all that we do in these categories where we are merging two asset classes is doing something that a advisor perhaps could be able to do himself. Further, he would be able to customize that to the needs of individual clients. So, yes, is there a role for these funds? Perhaps, maybe some investors who don't like to see the volatility that a equity product brings with it, and therefore it gets sort of camouflaged when you put it into a product which is giving you a single NAV and moving between asset classes. There are some advantages. I also know there are some people who like to use these products to create an income stream, perhaps by STP. You talked about flexible. So I think many of these routes can be used. But my simple point would be that underlying a hybrid strategy, whether it is aggressive hybrid, conservative hybrid, or balanced advantage, is asset allocation. And an advisor or a distributor is equally capable of creating those allocation models for his own clients. So it's a question of the choice of the distributor or advisor as to which product he would like to place in front of the investor.
Thanks, Vetri. So one final question. In fact, this is the question coming from most of the participants online. So somebody, like Pallavi Rawat, Bhupendra Patel, Abhay Taskar, Giridhar, Somnath, many more, in fact. So question is obvious. The equity markets are at all-time high. Inflation is expected to go up. So what should be an equity investor course of action in the current market environment from an existing as well as the new investor point of view?
So first point is don't worry about market highs. If you are investing in the market and you are planning to invest for the next 20 years, believe me, many times in the next 20 years, you should hope and pray that the market will be at new highs. Just earlier this month, one of my colleagues, our former head of sales, Debashish Mohanty, retired. And one of the things he told us at his retirement event is that when he joined the market, and the Sensex hit 500, there was a lot of concern in the UTI office on that day that, oh my God, the market has hit 500, what next? Right? And you know where that Sensex, which was 500, has now reached, right? It's crossed 50,000. So my simple point to you is new highs are not something you should worry about. It's bound to happen. You want it to happen in your investing journey over a 20, 30 year period. Yes, high valuations are something you should be concerned about. It gives you an opportunity to determine whether your asset allocation is appropriate. It is in line with your financial goals. It will give you the comfort that you need to achieve your financial goals. It is not risk inappropriate. And those are decisions that I think have to be taken at an individual, investor level by, telling them what is the right strategy for them. When looking between asset classes, as I said earlier, equities relative to their past history, certainly looking expensive. Whether we look at PE, price to book, you use any of those standard valuation metrics, yes, they do look rich to expensive. However, when you compare equities to the alternative, which is bonds, the outcomes are actually today still slightly neutral. The gap in earnings yield and bond yields is in line with the historical average. It has not moved very significantly away. So I would say still in slightly neutral territory between those two. Ideal thing to do, and we keep saying this, we always say investing is simple, but it's not easy. And the simple way to do investing, even though it doesn't sound very exciting, is to stick to strategies like SIP, stick to strategies like SWPs, and have an element of asset allocation rebalancing, which you carry out maybe once every year or something like that. So I would say just follow those simple policies rather than trying to sweat the details too much.
Thanks, Vetri. So I've tried to take as many questions possible in the given time. So since we don't have much time now, so we have already overshot the time. So I'll just hand it over back to you for closing remarks.
Sure. Thank you, Niranjan, for graciously running us through those slides and through all the questions. Most importantly, thank you to everybody who registered, who's attended this event, and sent in the questions. I'm glad we could, vary the format this time, bring in two of our fund managers so you get a chance directly to put your questions to them and seek their answers. And, we'll try and keep, experimenting with this format. Essentially, the idea and the purpose remains one simple thing: to sort of give you the answers that you're looking for as investors, as distributors, and as advisors, and therefore help you to do even better service, particularly for the distributors, to your clients and investors. So thank you very much for joining us on this call today. Wishing you, your families, and all of you very good health. And finally, I hope we can all push towards vaccination. There should be no vaccine hesitancy. Let's go ahead. Let's get vaccinated. That's the only way to get India back to work on her feet and, confidently moving ahead into the future. Thank you so much and have a good evening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.